What's up, everybody? So if you are a high schooler and you want to get on top of your financial future, this video is for you. My name is Greg Acton. I am a 36-year-old millionaire who's invested in real estate and the stock market. So today we are going to talk about the 3 accounts that you need to open up right now. And you may be thinking, but I am in high school. Why should I even worry about my financial future? I am telling you that if you start early, you are going to see amazing results. And so let's jump in. The reason you need to start early is because of compounding interest. That is interest earned on the interest that you are earning every single year. So it actually compounds, it rolls, and you're going to make more money the longer that you have your money in the stock market and in investments. So first account that you should open is a high yield savings account. And this is something that you can just put an emergency fund in. So put $1,000, put 3 to 6 months of living expenses, whatever you want to do, put it in there. I would not put a whole bunch of money into this place because this is just when you need cash quick. Maybe you don't want to sell off some stocks if you have a gain. So just put a little bit of money in there, save it up, and don't look at it, don't worry about it unless you truly have an emergency. These high yield savings accounts are nice because they can make you 4 to 5% right now, which compared to a traditional savings account is significantly better. If you just have it at a regular savings account in a bank, you're making jack crap on it and you need to move it to somewhere where you can make more money. Now, account number 2 is a Roth IRA. An IRA stands for Individual Retirement Account, and Roth is a designation for tax purposes. So a Roth IRA, when you put money in, it is money that you've already been taxed on, and you are going to leave it in there. But check this out. Any growth that you have on that Roth IRA is completely tax-free when you retirement. Now, a couple things to note. Once you put money in, it has to stay there unless you are willing to pay a penalty. If you take it out before you reach retirement age, you're going to have to pay a 10% penalty tax. And there are some loopholes on some things that you can pull it out, like if you're first time buying a home, some education expenses. But for the most part, you have to put that money in there and just not touch it. Otherwise, you're going to get a penalty for it. But in my opinion, this is an awesome way to save for retirement. So I'm going to show you an investment calculator that just makes a huge difference. Check this out. So we're going to go to this Dave Ramsey investment calculator. So let's say you're 15 years old and you want to retire at 67 years old. You don't have anything in your retirement account right now, and you're going to invest $100 a month, and you're going to make a 10% return, which is the average for the S&P 500 index. So the S&P 500 index, you can go and buy an index fund, and that invests you in the 500 biggest companies in the United States, and they average about a 10% return. If you calculate that out, you will have put in $62,400 over that 50 years that you're invested in. But your growth is $2,054,000. So you're going to have $2.1 million in your retirement account just by putting in $100 a month. And that's insane. Like if I waited until you were 35, you'd probably have to put in like $600 or $700 a month to even get close to that 2.1 million. So starting early has a significant impact. And if you do it in a Roth IRA, that $2 million of growth is completely tax-free. Now you are limited on how much you can put in. So 25, you can put up to $7,000 every single year into your Roth IRA. But my suggestion, if you want to start small, start $50 to $100 a month, start building that up and just put it in, and you don't ever have to think about it again. Put it into an S&P 500 index fund and just watch the sucker grow until you're ready for retirement. All right, the third account that I would open if I were in high school is just a regular brokerage account. So this is one where you can buy and sell stocks. Robinhood has it, Webull, you can do it in Charles Schwab. But this is where you can go and buy and sell stocks. It does not have the tax benefits of a Roth IRA, but you can pull it out whenever you want, right? So invest in this, and then when you're ready to buy your home, you can sell those stocks and you'll have seen some good growth. Granted, you are going to be taxed, but it's going to be at capital gains rate as long as you hold the stock for longer than a year. And then you can take that money and go and buy your first home or go and pay for college or anything that you'd like, but that way your money is invested. It is ridiculous and it is dumb to leave your money in a savings account and where it's making like next to nothing, right? Any money outside of having your emergency fund should be invested and making more money for you, and a brokerage account is a great way to do it. All right, I've mentioned this, but now that you've got a Roth IRA and you've got a brokerage account, what should you invest in? I know I personally invest into an S&P 500 index fund. Like I've explained, that is just a fund that invests your money. It spreads it out over the 500 largest companies in the United States. What this does is it reduces your risk, right? Because you're not just invested in one stock. And if that one company goes down, then your money goes down. This way you are diversified. That means you've spread it out over 500 different companies. You know, some of them might be going down, but some of them will be going up. And on average, they go up 10% over the last 30 years. So that's where I invest, is into an S&P 500 index fund. Now, how often should you invest? I would invest every single month. Don't worry about trying to time the market. Some people go, oh, but I want to buy when it's low and sell when it's high. And I 100% agree, that would be the best strategy. But it is so hard to time the market and know exactly what's going to happen. So there's this thing called dollar cost averaging, is where you are just investing consistently every single month. Now, if you do this, there are going to be times when you buy at the low point, and there's going to be times when you actually buy at a high point before it drops, right? But over time, if you do this over time, you're just going to average out. So sometimes you'll be invested low, sometimes you'll be invested high. You'll just average out, and you're going to you're going to be able to take advantage of long-term growth. And so do some dollar cost averaging and just invest consistently and start early. The great thing about doing this is, I know for me, when I was in high school and even in college, and honestly right now, I like to have fun. I want to be able to go ride my dirt bike, and I want to be able to go do fun things, right? And all of that takes money. But if you get into the habit now of just investing small amounts, you won't have to invest an insane amount of money later when you're in your 30s and 40s and you're like, crap, retirement's coming up. I want to be able to retire. I need to throw way more money into it. So this is actually going to provide you a whole bunch of freedom in your teen years, but especially in your adult years, right? If you want to be able to go and buy a dirt bike when you're a little bit older and go and ride it, then start investing now, because then you don't have the stress of worrying about, oh, do I have enough in retirement? Because you started early and you're taking advantage of compounding interest. So it doesn't have to be a restrictive thing. It's actually going to provide you a ton of freedom. Now, if you have any questions, please hit me up in the comment section. We'll catch you guys next time.